Hello, everybody. Welcome to Module 4. We're going to be going over really the more traditional investments that you probably, when you signed up for this class, you thought, hey, we're going to learn about. We're going to learn about the stock market. We're going to learn about, bonds, mutual funds, ETFs, and, if you know maybe a little more about the market coming in, options. And so that's what we'll spend the next really 3 modules going over. This first module is going to be dedicated to the stock market, understanding its characteristics and how it works. You could spend a whole class on this. I probably know a little bit more about the market than I do other investment types, just simply out of personal experience. It's been a little while since I took a master's level class over this, but nonetheless, I've been able to teach it here at Hannibal LaGrange for, I think this might be the 3rd or 4th time. And one thing that always impresses me is just how many people, just haven't really been able to, especially, you're in your maybe early 20s, really pay attention to the market or focus on it. It's just kind of something that is there, and the truth is, like, it's interesting if you ever you need a little bit of an inclination and desire to study it and learn from it, but nonetheless, like, it's something that we are all gonna have to be immersed in. Like, we all will. Like, it doesn't matter if you're a business major or an education major, anybody out there nowadays. Our investment retirement accounts are tied to the market. We're gonna we're given responsibility over those to choose what types of investments we might want. And it's important for us all to understand the inner workings of the market, to really understand at least the basics of it, right? The complexities, maybe not so much, but you need to understand how a stock is valued. You need to understand, the expected returns for the market. There's so many people out there who just choose to, try to shy away from it, as if those the returns you might get in the market, with the ups and the downs, those downs really scare them. And so, they choose to, to almost opt out in certain ways, but they're always, your retirement, your 401k, your pension plan, your IRAs, they're all going to be invested heavily in the market. And maybe it's just in an index fund that tracks the S&P. Nonetheless, like, it's still going to be important, and you're still going to need, to at least know these basics. And so I'm glad you guys are with me today. In this class, I love going over the market. It's not that complicated. Give you some readings throughout this class, but one guy that has always kind of been a market guru, his name's Jim Cramer. He's always on CNBC. He's a bald dude yelling at people. He says it's as easy as 5th grade math, and this is really, especially what I get to show you today, is an example of that. And I mean, sometimes you have to add zeros to it, and once you start looking into valuation and ratios and things like that, which maybe you'll need to do at some point in the course of your life, it definitely helps you. And if you're in accounting, or if you get into corporate business, all of that is important. But nonetheless, even those numbers and how they're derived is usually pretty simple. The stuff that you've done with the time value of money, internal rates of return in this class, are just as complex as anything that you'll look at whenever we start figuring out valuations for the market. So I'm going to share my screen and we'll get going. I'm going to have 3 PowerPoints I'm going to go over. Each of them kind of touch on different aspects of the market. So we'll start with this one. This is, I believe, Investments, Chapter 10. I'm trying to figure out which file name it is. 4.1 Stocks 2. So we also have 4.1 Stocks 1. Let's start with Stocks 2. So, if you went over these yet, you might look at the second one first, because it talks a little bit more about the the branch of investing that I want to talk a little bit more about too as well. And here Warren Buffett, another market guru, he's called the Oracle of Omaha, bought into a textiles company and turned it into a big conglomerate that owns everything from Geico to Dairy Queen to Burlington Northern, Helzberg Diamonds, all these different companies rolled into one, Berkshire Hathaway. Warren Buffett says, close the doors, be fearful when others are greedy, be greedy when others are fearful. And in order to really be successful in the stock market, and what I mean by successful, to outperform just the averages, you have to have a little bit of a contrarian's mindset. My personal opinion when it comes to the market is find what you want to own for the long haul. You know, and I'm talking like the length of your life, almost 40, 50 years. Buy it and continue to keep buying in. You know, don't be an active trader. Don't buy and sell and buy and sell. So I've shown this quote before because I think it's interesting. Wesley, John Wesley, the famous pastor from England, Wesleyan, the Methodist Church founder. Phenomenal guy, interesting story. He said, you know, he's like, when he was younger, living off of like 50 pounds a month, however that much that was back then. He said, I can live off of this comfortably, and so I will for the rest of my life, no matter how much I earn. Well, you know, he wrote a lot and ultimately ended up, you know, getting some money and royalties from things, still nonetheless only lived off those 50 pounds a month. His philosophy of investing isn't necessarily about, obviously it's not about greed or gathering as much as I can, you know, just because. And this kind of goes back to that investing theory class we had last time, right? Like what utility are you getting from this? Investments should always have a goal in mind, you know. And he said, earn as much as you can, save as much as you can, invest so that you can give as much as you can away, right? And it's really easy to get into this mindset of I'm going to be mighty and powerful, you know, with my money, or I'm going to be ultra rich, or I'm going to, you know, hit it big. I'm going to find that investment, that Tesla or, you know, Amazon company that's going to make me hyper rich and turn $100 into $1 million. And you know, while those ideas, those stories do happen, you know, what is really the heart behind why you're choosing to invest? Because if it's just to make yourself, you know, ultra rich, someday that'll end up not being so satisfying to you, I think. You know, there's another piece to investing as well, and this quote kind of gets at it in the fact that when you invest, you really are, you know, you're banking on our future, which is an unknown. That's why the risk piece comes into it, which we had already discussed. Okay, but you must believe that tomorrow is going to be better, that we will grow as a people, as a society, that that things will be stable enough for that. Living here in the United States, we have an expectation of that, which is good, because we've been fortunate enough to be put into one of the most stable situations in all of human civilization. But that is by no means the norm when you look across the board. And so, you know, even though you know, we have an opportunity to be a part of the market, be invested in the market, you kind of have to look at that and say, wow, you know, we are really saying we expect to see growth, improvement throughout the rest of human history. This investing definition is something I made up, and it's I don't know, maybe it's a little too wordy or whatever, but what is investing? Deferring the right to spend any capital that you have today. So you have to have it. I mean, you can borrow money to invest in, but that's a bad idea anyway. And so really it has to begin with savings. And so you go back a few lessons whenever I spoke about, you know, hey, you have to have your personal finances in order to even get to the point where investing matters. That's kind of the idea. You have to defer the right to spend today and then you have to utilize that deferred capital to produce more capital in the near future to have the right to spend that accumulated capital and what you saved in the future, right? So you always have two pieces to it. You have what you started with and what you've grown with. And what's cool is over time, you start with this little bit of money, and maybe it's just $100 a month or $1,000 a year. When you're younger, even if you're in college, man, like I get it, you're scraping by. You don't know if you can have enough money to even get through the semester, but if you can save just a little bit to start that habit and see that money and see how it grows, it gets you excited. Whenever you do finally get that job, you get in the real world. Potentially, maybe you'll be more excited about that than you will even buying a nice new car, which seems to be the first move a lot of people in their early 20s do, right? Hey, what happened if I, instead of buying a $30,000 vehicle, buy a $8,000 vehicle? It'll give me just as well, almost just as well from point A to point B, right? Without all the Bluetooth stuff probably in it. Take that $22,000 I would have spent on that car and invest all of that money, right? And then you pull out your little calculator and you realize how valuable that would be to your life and how, your trajectory changes. Maybe you get a little more excited about investing than you will about other things. Maybe not, but nonetheless, that is the definition of investing. You have to save. And so why do we invest? Why do we invest in personal finance? Some of this is review, but nonetheless, we have to counteract inflation, prepare for retirement, augment our income, provide inheritance, maximize utilities. So hopefully this is a good review. I always try to touch on, especially in my investing classes, the corporate piece as well, just because, there's investing that goes beyond just the personal finances. And so, in corporate finances, the world of investing is looked at a little bit more strategically. And I'll teach a corporate finance this spring, and we talk quite a bit more about growth models and outputs, risk management, through those things, and it's important as well for us to understand that, in personal finance we have these different avenues to invest in. In corporate finance, you usually want to focus up on, hey, how's my business going to make money? Hey, and so now how can we maximize that to the greatest? And yeah, you'll have to do some, capital budgeting and future allocating things to get there. So these next two units, module 4 and 5, go over the stocks and bonds. And for me, it's always really important for us to understand the difference between investing in ownership versus investing in loanership, which maybe I coined. I bet if you looked it up on the internet, there's someone else that said it. But equity represents ownership. So what is equity? Well, you can read through those things. Basically, equity is owning stock. It's owning shares in something. It could also be owning a rental home or owning something else. But you actually have a piece of ownership in it, and because of that, you have residual claims if the company goes bad. You're dependent upon success of a company for profit. Typically, equity, because of the fact that we are always doing valuations, has more risk, but also more reward than debt. And so why is debt safer, right? Because, it seems to me like, debt's a bad thing and equity's kind of seen as a good thing. Well, when you invest in debt, you don't have ownership. It's like a loan, right? No right to future earnings. You're not dependent upon the success of the company as much as you are just hoping that they can pay their bills, because you are a bill that they own. So if you invest in bonds, that would be an example of that. You're not going to get as high of a return unless you're investing in junk, which we'll talk about. And when I say junk, I don't necessarily mean like bad investments. I mean junk bonds, companies that are less than stable. But you have a prior claim if you own in debt to a company's assets. More likelihood that you'll get your money back if a company does happen to go south. And so the question, what is equity? What is a stock? Well, okay, stocks go by a lot of different terms, right? Securities are stocks. Stocks are securities, I should say. They represent a piece of a corporation. And so this little infographic kind of shows, hey, here's a company. What is a stock? Well, if you divided the company into, oh gosh, billions of little pieces for most part, if you're talking about big companies in the market, then you know, that is what a stock is. And so you know, that's kind of how it works. And so how do, you know, stocks trade and how they operate? Well, they should, at least in theory, be tied to the value of a company, okay, the money it can produce, the direction it's heading, and you know, the overall well-being. You know, is the company in good shape or bad shape? And so if more people want to own shares in stock and less people want to sell, the stock goes higher based on supply and demand, which you see in the little graph there, right? And vice versa. And so ultimately, you know, we see really, I think, a cool opportunity that we have. Like, not very many opportunities in the history of humanity to be a part of, you know, the capitalism process, like to actually be able to own things. I taught a lot of history and world history, you know, like you go back to the Middle Ages, you know, you think those serfs and peasants had an opportunity to really partake in the means of production for anything? Like, no, they didn't. Like, they were the means of production, but they had no say in it, and they sure as you know, golly, didn't have any opportunity to actually you know, put anything that they might have been able to save away into a system that would produce growth, produce wealth. And we have that nowadays, you know, as much as people want to fight against that. That is what's really neat and exciting about the world that we live in. It's as easy as, you know, honestly, picking up your phone and starting a brokerage account. In 10 minutes you have a stock, you know, and you can grow that, you can make it work for you. But you really do at that point, you know, talking about, you know, idea of Marxism and all that stuff, like you have ownership in the means of production, you know, and that's a good thing, right? Like that, in many ways, if people put more realization and value into that, maybe they would, you know, at least recognize the good that we have in the systems that we do have, even though obviously they're not perfect. And one example of that imperfection is just the goal of corporations, right? And so, like, if you own stocks and shares, you have to understand that the corporation has a goal, and it's going to drive every decision that they make. What is it? Well, it's money, and it's not just money. Okay, it's to make their shareholders money. Okay, and so the issue is this. All right, you know, if you're a publicly traded or even a privately held corporation, okay, you're going to put those people who have your shares, okay, and the ability to maximize their profits above all of these people's listed debt holders, employees. And you can already see that there would be issues with that, right? Like, well, a company and corporation should treat their employees well. It is that the ultimate overarching #1 goal of a company, okay, to make sure that their employees are treated well. Unfortunately, by definition, it's not, right? And so you need checks in place to make sure that employees are treated well. And in the end, it can all point in the same direction, right? Like, if you're treating your employees well, your corporation will be more stable, you'll have less employee turnover, right? You know, you're going to be in a better place in a lot of ways, okay? But we see that constant tension, fighting back and forth to find that middle ground, that happiness, all the time, right? And so, like, if a corporation is trying to, you know, get its employees to work for less, that does fall in line with the goal, right? But it's not necessarily, you know, a good thing. I'm not saying that. Don't hear me what I'm not saying. So, partners, consumers, management, the environment, all of that comes second to shareholder value. Okay, and we have to always remember that. And you know, just because that is kind of the definition of what a corporation is and what its goals are, doesn't necessarily mean that it has to be driven by that. I mean, there's a lot of stuff going on right now, like presently, like in the last few months even, just trying to figure out, should corporations have a social conscience? Should they have goals that exist beyond just making profits for shareholders? And I would say yes, they can, they should, right? And those goals especially should fall in line with the purpose of their corporation and their mission as well. You know what I mean? So like if it falls completely far from the tree, then it's not necessarily going to help them if they're really fighting for and advocating for certain types of rights, even though their corporation doesn't necessarily fit within that. So anyway, nonetheless, let's keep moving on. We're getting obviously a lot of background information, and we're not quite to the big piece about figuring out stocks and values and things like that. But understand that there's a difference in the corporate world between management and ownership. All right, which again is something that we confuse quite a bit when it comes to corporations. Okay, managers are those who are actually doing, operating. They're the operators, whereas the owners are the ones who are the shareholders. Okay, they're represented by a board of directors that then oversees that management process. Okay, so I know I do own some shares in some companies. Like let's say I own Ford, right? I'm not involved in any way, shape, or form in the management process. I learn a little bit about it, and if I think that it's managed poorly, I might choose to sell my shares and not become an owner anymore. All right, but you need to understand those two distinctions, right? And I'd say a normal everyday person doesn't, who really get that, the difference between the two, and their goals, just like the goals here, will sometimes chafe against each other. These will as well, right? Are we going to increase salaries? Or are we going to want to see our earnings increase? To be an example of that. All right, so getting into stocks, we have basically two types of stocks, and we usually only talk about common. Okay, common stocks are stocks ownership in a corporation coming with voting rights. Companies can also issue out preferred stock, okay, which are actually kind of a combined share of debt and ownership in a corporation that do away with voting rights. However, they kind of actually act a little bit more like a bond would in the way that at least the investment profile is. We do have ultimate obvious risks if you invest in common stock. You when you own stock, want to see it go higher, but a stock could, and the corporation could fall out and go to zero. All right, and that does happen. It happens actually quite frequently. You might have heard of penny stocks and things like that. Those are companies that are out on their luck. They're almost got one foot out the door already. But here's a company that you could have invested in, right? Like GTAT, some type of tech company, ultimately falls out, can't hardly pay and cover its debts. Its future doesn't look bright, and because of that, the market starts to send it south. People don't want to buy into it, and surely enough, ultimately ends at zero. So that does happen. That could happen. You don't have to invest very long. Start especially looking for big gains and taking risks. Like you're gonna find stocks that go to zero. It's gonna happen. If you stay with the big stalwarts, maybe not, but you could still lose money or see your money stagnate in those as well. And so that is a big risk. The reward, I think it's pretty common sense. You want to see a company that goes and increases in value. Here was one I gave classes a few years ago. Chipotle. Look at that company. Just goes from pennies to what was it, $600 a share at that point. And that does happen. That is why people invest in the market, and that's a good thing. Okay, it can increase in value, and then it can also, stocks can pay out in dividends, which are typically quarterly payments of cash to their shareholders out of their earnings, okay, or out of their stock pile of past earnings. And so there are two forms of dividends, but guys, I'll be honest, stock dividends are so uncommon that I almost don't even care to talk to you too much about them. Cash dividends are pretty much the way that the companies pay out. These dividend dates are important to understand and know, okay? So if a stock's paying out dividends, how does that work? Well, a corporation typically at some point will say, hey, we're going to, so like it's winter 2020, right? They're going to say, if they normally pay out a quarterly dividend, on February 15th, we're going to pay a dividend. And so that's their declaration date. They'll say, you know, Disney will be like, we're going to pay 34 cents per share. The date of record is the day that you have to own that share. So they're saying on February 15th, we're going to be paying that out. And so actually we're going to mark that record on February 14th. Okay. And then February 15th would be like the date in which all of that, you know, is finalized, kind of recorded, put in the books. Ex-dividend would be the 15th. Okay. If you bought stocks on that date, it wouldn't count. And then the distribution date is usually a couple weeks after that, where you would see that money credited to your account. And it used to be they'd send a check in the mail back in the days. Nowadays, you just get that money into your account and you can go roll it in, reinvest it into that corporation or use it as you need. Here I talk a little bit about, I just want you to start understanding the effects of the market. And so if you look at dividends, you know, if you go to a website, you'll typically find, especially if a company pays out a bigger dividend, that on X dividend date, people will sell, you know, and it'll cause just a little bit of a dip. And so like the ultimate question is like, can I game the market to make more money? And people figure out about dividends. They say, students usually are like, well, I would just buy a stock on that date of record and sell it on X dividend date. And the truth is, the funny thing is, ultimately, like if I pull up a stock, Google, no, let's do Yahoo Finance, a stock with a big dividend. Well, let me think about this. Let's just do Ford. No, let's do AT&T. They'll have a big one. You'll find that the company actually goes down usually around the amount of that dividend. You know, so like you wouldn't make money doing that. And that's just, you know, what you have to do to figure out how the market works. So here, oh man, I forgot, Yahoo doesn't show dividends, do they? Well, it shows obviously how, you know, their ex-dividend date is January 8th, and how much their dividend is. They get on here and change everything around so often. Anyway, yeah, here we go. Forward dividend and yield. So they're paying out 7%, $2 per year per share. So it'd be about what, 51 cents, 52 cents per quarter. But anyway, you'll usually see stocks dip during those times. So anyway, dividending is a good idea or not, you know, there's a little bit of challenging back and forth on that idea. Stock owners do have voting rights. I'll be honest, unless you're, you know, if you're a small investor, like most of us will always be, voting rights are like kind of like your democratic process. Like, you're glad that you have them. The likelihood that you'll ever really change outcomes, you know, just because we're speaking of corporations that have hundreds of millions of shares, probably pretty low. Nonetheless, just kind of like, you know, if you go to vote in November, nonetheless, it's good. You know, it's still a good system. It's the right system, and you know, it helps us understand a little bit more about how corporations work, to know that. So here I do a little bit of figuring. How do you really understand how stocks cost? And that's a, you know, a little more complex than just like, I bought a share at $10, I sold it at 11, I made $1. You usually have to factor in some things. So an example of that would be transaction costs. And I'll be honest, guys, with the you know, the advent of Robinhood, transaction costs have went to zero. They make money by basically investing the money that you don't invest, that you keep in your cash account. And that's what they do. And that process has been long and kind of interesting to follow. Even when I was little, like in the 80s, I don't remember much about it, but like you would have to go to a brokerage someplace, like you know, an actual person, maybe an advisor. But you would have to actually, or you know, you could call them up on the old landline. But you would pay 50, 60, 70, $80 just to buy or sell a stock. And then we had the internet boom, you know, where people are actually be able to sit down at their desktop computers and buy and sell shares of stock. And so that got undercut, that process did, which is really good for investors. $10 trades was such a big deal. I mean, I remember I could still envision a million different advertisements I saw about that kind of stuff, you know, like $10 trades, and then it was $7 trades, and then $5 trades. Now, Robinhood and you know, these cell phone investing things have even undercut that. And they said, you know, like we can do it. We can make a lot of money just on people putting their cash into our accounts and waiting to invest that cash. Well, we'll invest their cash for them while they're waiting, right? And make the difference there. And so investing in stocks now is free, and it really opens up the world to you guys, because now you all have an opportunity to go out there, and if you wanted to, you could buy one share of something for $15, not have to worry about the transaction, the commission fees that you would have to pay for that. You know, it's easier to accumulate stocks. You can even buy partial shares in Robinhood if you want, and other similar types of apps. Seems like Robinhood is the one that you guys are all using. And I think that is good. I really do. It gets more people involved in the market, you know, at an earlier, younger age. Robinhood has come under fire for being a little bit too like a video game, you know, like trying to appeal to the younger generations, you know, they get excited about it. And so because of that, it can kind of stir up a little bit of more of, the addictive nature in us that want to, you know, gamble. Even though investing is not gambling, right? If you're looking at your stocks every day and you're buying and selling, trying to make just a little bit, you're becoming an active investor, right? If you did that for a living, you'd be a day trader. And that's not the type of investing really that we focus on in here, because it's interesting, but research shows it's really hard to beat the market, period. And you have to really know your stuff. And you know, Robinhood is a great introduction to those things. But in the end, I hope you kind of hear what I'm saying. So nonetheless, one thing you would have to consider is the tax implications for trading of stocks. And so if you buy and sell a stock, yeah, you made $1. You think you get to keep that money, but you should actually probably put a little bit of it away, because the tax man will get you later on. And I actually opened a Robinhood account just a couple weeks ago for you guys to be able to figure things out, especially when we look at the options section later. You know, it's I'll bet the taxes, I'll wait till next year to talk a little bit about that, but I'll bet it's going to be a little more complex than people would like. And so if you buy and sell shares, you've got to pay capital gains on that. You know, and those capital gains taxes can eat away into your real return on an investment. So, all right, I'm going to jump right into our next PowerPoint. One more picture here shows the S&P 500 in an infographic. This is, the S&P does change. You know, 500 of the most representative companies in the market is kind of the goal. So you see the tech, the financial, consumer goods, services, basic materials, you know, all of these, okay, compile to make the index. That's how that works. So let's talk a little bit more about features of the stock market. Investing definition we just went over. What is a characteristic of a stock? Share of ownership in a corporation. And so that pie idea, where you're dividing the pie up to look at different shares, value of shares is a good, you know, representative example of that. Here's some additional stock characteristics, some interesting info about international stocks if you wanted to look at that in a little while. Our stocks on our big board in the United States, you have the New York Stock Exchange, the NASDAQ, and some other ones as well, you know, the American Stock Exchange in Chicago. But typically the corporations that are biggest that you know most about, New York Stock Exchange, and then those that are tech companies are typically going to be on the NASDAQ. How do you invest in the market? I don't get too involved in how the markets are made. It's a little arduous. You don't have to know that. I think it helps at times if you're trying to really figure out some more intricacies of how the market moves, to look at the intermediaries in the market, the market makers, which basically are the people who help match buyers and sellers and send that over to you know, to the actual stock exchange. Arbitrage is a process within that as well that helps us understand what some people are out there doing, which is looking for a way to make minuscule amounts of money without taking on any risk. So nonetheless, you have to go through a credentialed certified broker. Yes, Robinhood is a certified stock brokerage. Open an account. You know, the two types are full service and discount, which I just talked a little bit about. Basic types of orders, if you actually put in a stock order, is a limit and a market. Okay, and market orders guarantee that you're going to, like, let's say you want to buy shares in you know, Bank of America. You put in an order, market order initiates that transaction immediately. All right, whatever the stock price is. And what happens is the market makers, knowing that that's a market order, will actually bid up that Bank of America share just a little bit, all right, to guarantee the sale of it, so that you can guarantee that you get it, which they make money off of, right? And you lose because you sell it, you're buying it at just a little higher price than you would have if you put in a limit order. And so stock market 101, if you invest in the market, put in limit orders to guarantee that you'll buy a share at whatever price that you have put at. Now, if you're seeing a market, the stock that's changing rapidly or going up rapidly, and you want to buy into it, you know, you say, hey, I want to buy at 20. Okay, you might not get it. Okay, and what I usually do is I'll actually put in a limit order below where it's marked at, you know, because I'm not one that's trying to catch stocks as they rise and do anything crazy anyway. So, like, you know, let's say Ford is trading at $9 a share, I'll put in a limit order for $8.75 and wait, and typically it'll hit it. And if it doesn't, you know, then so be it. But that's usually the best way to play it. Know that there's a big regulatory environment that you know, has to track the market, because the market is you know, full of people wanting to make money. Imagine that, right? But because of that, we have these systems in place that help us keep that in line, and that's good, right? Like, regulation helps the market do what it's supposed to do, and it limits insider trading, the spread of false information. All right, limits fraud, market manipulation. There's all of these issues, okay? Because to be honest, you open yourself up, you know, to those challenges whenever you do invest in the market. It is what it is, okay? But an example of that being like Enron debacle in, you know, the early 2000s. Like, how are you supposed to know that the accountants were baking the books? You know, they were like putting out false information. Investors were investing in it. Like, there's no way for any of us to ever know that that's the case. And so the government, rightly so in most cases, steps in to make sure that those things are operating fairly and transparently as they should be. So that being said, stock investing 101, and just the language that we use. When you purchase a stock, you're expecting it to go higher. So we call that going long. And it is the opposite of going short, okay? Going short is when you expect the stock market to depreciate, and so you can actually short stocks as well as buy them. And so the process for buying them is pretty easy. You get it, you expect it to go higher, you sell it higher, you make money, right? Shorting stock is when you take a loan, you kind of borrow someone else's stocks, sell them immediately. All right, and then you expect that stock price to go lower, and then you buy it back when it does go lower, and so now you've given it back to them at a lower price than what you paid for it, so you make money on it going down. And so that is an investing idea, process. It's riskier than buying stock, because if you short a company and it goes up higher, you find yourself in trouble, right? Big trouble, because it could go up forever, right? And you owe that now you owe on that appreciation, the amount that it's grown, to the person you borrowed it from. Stock features include the ticker symbol, the price, the earnings, price-to-earnings ratio, the bid and the ask, and the beta. And so all this information is typically available, if you go to websites. So like what I'm going to expect you to do for your project, is find Yahoo Finance, Google Finance, or use your phone, or whatever, method of information gathering you want, and start collecting that info. The bid and the ask is telling us how much people are willing to buy and sell it for, and in what kind of lots, sized shares that are out there. And so the big idea, I think, here is that people typically assume, okay, so we're looking at AT&T, right? $29.40. So it's worth $29.40. That's how valuable it is. And that's not really the case, okay? And we'll talk a little more about that as well, okay? The matter of fact, I'm going to talk about it right soon, yeah. Let's go ahead and go over that. So, take an example of Coca-Cola and Pepsi, right? Coca-Cola, whoops, not what I wanted. Where are we going? All right. Not too sure what's going on. Showing me the mini Dow Jones Industrial instead of PepsiCo. So let's compare these two companies. Pepsi trades at $146 a share. Coca-Cola trades at $53 a share. So one seems to be 3 times more expensive than the other. The truth is, though, you can't really look at that. That's not how the stock market works. Why? Because Coca-Cola and Pepsi have a different amount of shares out there. The different pieces of the pie that you buy with one share are different from one to the other. So how do we properly value these companies, and which one is the most expensive? Well, let me show you. Let's go back to Pepsi. Pepsi trades at $146 per share. All right. The best way to understand its actual value is to see how much money it's earning per share, all right, in relation to its stock price. And so here we see it's earning $5.05 per share, okay? Take 146 divided by 5, and we figure out that it earns $5 a share. It is trading at 29 times its earnings. People are willing to pay 29 times what it makes per year to own one share in Pepsi. All right. And that 29 times is the price to earnings ratio. Some people call it the multiple, but it is an indicator of really the best idea of how we can value a corporation in relation to each other. Coca-Cola makes $1.93 per share, $53 per share, okay? Trades at 27 times earnings. $1.93 times 27 will get you this number here. 53 divided by $1.93 will get you 27 times. All right. So Pepsi seems to be, if you look at its stock price, you would say, oh man, Pepsi's 3 times more expensive than Coke. All right. But that doesn't mean anything. What we're actually looking at is its price to earnings ratio. And we find Coca-Cola trading at 27 times earnings, Pepsi trading at 29 times earnings. So Pepsi is a little bit more expensive than Coke because it trades at a higher multiple price to earnings ratio, but not by much, okay? And so that's how you value stocks, at least at its basics, okay, is looking at how much it's making and its earnings, okay, per year, and then comparing that to others. And so we're, if you want to dig deeper into the basics of these financials, you would look at its balance sheets, its income statements, okay? And I put this little picture up here because we have all of this information available to us on the internet, required standard practice, of accounting to get us there, all right? So that we can do what this pair is having a tough time doing, all right? So we can compare apples to apples and oranges to oranges when we're looking at companies, because it would be really hard to compare apples to oranges. That poor judge, right, is an example of that. So those the income statement. You can also look at cash flows to determine how a corporation is doing. And then ultimately, like I just talked about on that, looking at Pepsi and Coke, earnings, okay, are a big deal, okay? Earnings per share are what we compare it to. So investors are usually concerned with earnings per share, which kind of gives you the example of that. Now, you have other issues that kind of you can run into. In theory, what I just said makes a lot of sense. If you really know how the world works, you'll understand that accounting is a tricky process that can sometimes be, you have earnings before interest and taxes, depreciation, amortization, all these other things that factor into the earnings game. But nonetheless, all right, earnings are the biggest focus. Profits minus expenses is your net income. Subtract that from your dividends that you're paying to preferred shareholders, and you get your earnings, okay? Price to earnings ratio is the greatest indicator for us of how valuable a corporation is, and that's not always the case. I mean, we've got thousands of corporations out there who don't even have an earnings. They don't even make money. They're still losing money, but they're growing and expect to make it in the future. Matter of fact, a couple of years ago, even Amazon was in that category, still had not been making money. Why? Because they were taking all the money they were making, and instead of just, having earnings, they were just rolling it into their growth. You can't say it didn't work out well for them, So anyway, other important factors of this, okay, we can find now some different models, to look at. And so the dividend model helps us understand just exactly how much we pay out in dividends. Dividend growth model helps us understand if dividends are growing. The risk premium model is really a basis and backbone for investing. And so I ask you, I believe I asked you to do this in your project. It's very simple. Okay, if you're looking for a return, you take the risk-free rate of the market. Right now, risk-free rates are very low. Okay, because that is what you would be able to get on short-term government bonds. All right, and then you take basically average market returns, okay, minus your risk-free rate, multiply that by the beta of your stock. And if you remember, that beta is an indicator of volatility of the company based on the market. So here we have Pepsi has a beta of 0.58. So it actually doesn't move as much as the whole market does. And because of that, it's seen as a safer investment. And ultimately, what do you get out of that? You get the kind of a required return based on risk, okay, for your stock. So anyway, I'm going to stop there. That presentation was a little longer, but I've also got one more PowerPoint as well, 4.2 stocks here, to talk a little bit more about IPOs and splits and dividends and then ratios. I'm going to let you guys work through those. There's not a ton of information out there. It's new to us. But if you have any questions, feel free to text, to email. You could even call me if you like. But hope things are going well as you work through these things. I think most of the questions will probably come from your project, so don't hesitate to reach out to me if you have anything. Thank you guys. Have a good end to Module 4. Bye.